Understanding leverage is very important for any trader or investor. We will first go through what leverage is, and then we will go through examples to help understand leverage. Without a good understanding of leverage, you will not understand margin trading, which is critical for having an understanding of risk management in trading. So what is trading leverage? Leverage refers to the use of borrowed funds to amplify returns for a trade or investment. Traders use leverage to multiply their position size in the market. Leverage in trading is shown as a ratio of the amount used in the transaction to the required deposit. This allows traders to trade with a notional value that's far more than the capital in their trading account. For example, if traders see their broker allows 1 to 30 times leverage for Forex majors, then this means they can trade with up to 30 times the capital in their trading account. Meet newbie Nick. Let's say Nick wants to control a $30,000 position. You would only need $1,000. This $1,000 is referred to as his required margin, which is basically like a deposit for the borrowed money, which he will get back after the trade closes. Okay, wait a minute. Tell me more about margin, asks Nick. Okay, good question, Nick. Margin is the amount of money required as a deposit to open a position using borrowed money from your broker. It's shown as a percentage. So for example, with leverage at 30 to 1, we do 1 divided by 30 to get 0.033, which means the margin percentage is 3.33%. By having the margin percentage at 2%, for example, we know that the leverage is 1 to 50, because 100% divided by 2% equals 50. Let's say the broker's margin requirement is 5%. Then it would be 100 divided by 5, which equals 20. Therefore, the leverage is 1 to 20. Take a look at this table to help you understand margin requirements for different amounts of leverage. Okay, that's enough. I get it now. So when can I start using 500 to 1 leverage so I can make millions? Asks newbie Nick. This is the type of mindset that kills new traders most of the time. As a result, the European Securities and Markets Authority, otherwise known as ESMA, introduced an industry-wide limit on leverage for Forex, CFD, and spread betting products for retail clients. Since 2018, they introduced laws that capped the leverage for Forex majors at 30 to 1, when previously you could trade up to 500 to 1 leverage. Equities, commodities, and most other markets were also restricted in leverage. This helps traders like newbie Nick to protect their account, and it helps brokers protect themselves too. Now that you have a better understanding of leverage and margin, it's important to take a look at some examples of how it can impact your trading. First, we need to understand what the term true leverage is. Your max leverage is represented as 30 to 1 for Forex majors, for example. However, your true leverage is your trade position divided by the amount of money in your trading account. For example, if you deposit $50,000 into your trading account and you buy one standard lot worth $100,000 of GBP USD at a rate of 1.0, then your true leverage is 2 to 1. You now buy another 3 standard lots, which is $300,000. Then your true leverage would be 400,000 divided by 50,000, which is 8 to 1. Let's say both the GBP USD positions are at break even. Therefore, the account balance and equity is still $50,000. Assuming your broker requires a 5% margin, then your used margin would be 5% of 100,000 plus 300,000. 5% of 400,000 equals $20,000 as the used margin, and the free margin is $30,000. To get a margin call, the price of GBP USD would have to drop 750 pips, as you have 2 long positions open. The first long position is 1 lot, and the second long position is 3 lots. Therefore, you're trading 4 lots in total at $40 per pip. $40 per pip multiplied by 750 pips equals $30,000, which is the amount of margin available in your account. Let's look at one more example before we move on. Let's say newbie Nick wins a local hair contest because his hair looks like Boris Johnson's, and he wins $50,000. The judges must have been paid by Boris, but let's not tell Nick that. Now, Nick's feeling very lucky, so he adds that $50,000 to his existing $50,000, therefore his balance is now $100,000. The same two positions are open with 4 lots long in total on GBP USD, with both trades at break-even and the broker's margin required is still 5%. Now his true leverage is 4-to-1 because he has $400,000 open with a $100,000 account. His used margin is $20,000, therefore GBP USD would have to drop a lot more than 750 pips like in the first example. Let's say Boris Johnson has a bad hair day, which makes him make a bad decision for the UK economy and the pound drops against the US dollar. How much would the price have to drop by for Nick to get a margin call? It would be 80,000 of his free margin divided by $40 per pip, which is his position size. Therefore, the GBP USD would have to drop a far larger amount of 2,000 pips for Nick to get a margin call. From these examples, you can see the power of leverage. Although margin and leverage are interconnected, they are not the same. You might have heard things like leverage is a double-edged sword. This is true because leverage can work to amplify your gains, but it can also amplify your losses. Therefore, it's crucial to have a good understanding of it. If you're new to trading, or you're struggling with trading, then we suggest you have at least a minimum of 90% of your account balance available as free margin. First, you should at least learn the basics of trading risk management and trading psychology before trying to learn more about trading strategies. We also advise sticking to only well-regulated brokers who follow the ESMA regulations as mentioned earlier. If you found value from watching this video, or you'd like to learn more about trading risk management, consider subscribing and click the bell icon for notifications. Also, don't forget to click the like button if you enjoyed it. Until next time.